stock market doesn't crash and the bond market doesn't become fragile. But he can't say it out loud. And so that elephant is just going to keep getting, every meeting that they have is just going to keep getting bigger and bigger and bigger. And at a certain point, somebody in the room is going to go, okay, the stock market's down 5%. What are we going to do here? So it's about clown world because we can't tell the truth. We can't be honest. Somebody yesterday on Twitter, they posted a list of 20 items where nobody's went to jail. There's 20 things and nobody went to jail on all 20 items. And we know that all 20 of them, people are breaking the law. We live in clown world now. And so the Fed has become clown world as well. And again, the only thing that really matters right now is stability in the stock market, stability in the bond market. Everything else is noise. And gold's going to be the eventual winner. We can see where this is going. The Humpty Dumpty crash is coming. You know, I've been doing interviews like this for a while now. And as we get closer and closer to my thesis, it just becomes so obvious that I can kind of see where we're going here. It's becoming more and more obvious, if you will. But it's complex to unpack it and explain it in 5 minutes, because this has really been building for 40 years. Mm-hmm. And so I think one of the easiest ways to understand this is just looking historically at what stock markets have done. I mean, if you go back to the 1920s, where you had that big run in the 1920s, followed by a 20-year bear market, pretty much. I mean, just a massive. And then you had the same thing happen, 80s and 90s. You had this massive run, especially the 90s. And then you had the correction in 2000, and it lasted a decade. And now we've had another 15-year run. And what's the outcome going to be? For me, it's very obvious. You're going to get a protracted bear market. And nobody seems to be expecting it. Mm-hmm. But these bull markets, they always end in euphoria, which is exactly what we have. For instance, if you look at the last two, 1929 and 2000, those both ended in euphoria. Everybody, oh, this is great, we're all making money kind of thing. And then boom. And that's exactly what's happening here. And I really feel that this is different than 1929 and 2000. And the reason why it's different is because in both of those eras, in both of those periods, the U.S. was the global leader. The U.S. was basically positioned in had a very strong position. In other words, the U.S. dollar was not at risk at those two periods, not even close to being at risk. Mm-hmm. And the bond market wasn't fragile.
Past market corrections occurred when the United States maintained unquestioned economic dominance. Today, the landscape is shifting. Nations are diversifying trade relationships, central banks are accumulating gold reserves, and competition among major economies continues to intensify. At the same time, rising government debt and persistent fiscal deficits have sparked concerns about long-term financial stability. Many economists argue that economic growth driven primarily by borrowing cannot continue forever. As living costs rise and purchasing power becomes increasingly strained, pressure on households continues to mount. These trends are forcing investors to reconsider assumptions that have guided markets for decades.
So it was a completely different. This one, we're actually going into a bear market in the top when the U.S. is losing. This is where it gets really complex, and you kind of have to know history. It's losing its position in the world geopolitically. And so when you combine that geopolitical risk with the U.S. economic risk, and the middle class is basically getting rug pulled here through this MMT, modern monetary theory, where we just use debt to expand the economy. Well, guess who's the loser is in that? The middle class is a loser in globalism, and it was a loser in financialization of the economy. And so we're basically building to a head here where the U.S. economy is going to falter. And when it falters, it's going to be worse than 1929, as bad as that was.
Hmm.
Because in 1929, we had the ability to get out of it, to climb out of it, to basically everything kind of stayed intact, if you will. This time, we're not getting through this one. I call it the Humpty Dumpty crash.
Hmm.
There's going to be no putting this one back together again. Now, the reason why I'm in gold and silver is because gold is the winner here. When everything goes down, you have $250 trillion in assets that are at risk between stocks and bonds. 100 trillion in stocks, 150 trillion in bonds. They're both at risk. Well, if those assets are at risk, where do people move their money to? And gold is the obvious answer. Gold is the winner here. So the gold miners, the silver miners, and silver, they're just along for the ride. That's not the story. The story is gold. The story is the bond market. I want to finish with this, is that we've gotten to a point now where people can't see this, but it's becoming the elephant in the room. So the Fed was supposed to have a dual mandate of price stability and full employment.
During periods of uncertainty, investors often search for assets perceived as stores of value. Gold has historically played that role, and recent years have reinforced its relevance. Central banks around the world have been adding gold to their reserves at record levels, reflecting a desire to diversify away from traditional financial assets. If confidence in stocks or bonds weakens, capital could increasingly flow toward precious metals. In this scenario, gold becomes more than a commodity. It becomes a financial alternative. Silver, mining companies, and related sectors may benefit as well, but the primary story remains the growing strategic importance of gold.
Well, that's
Indeed.
gone. That's out the window. That no longer exists. Even though they say it is, they're lying through their teeth. Because the elephant in the room now, whenever they have a Fed meeting, is how do we ensure that nothing burns to the ground? How do we ensure? So they're basically, the only thing they care about now is stability. It's not about full employment or inflation. You know, they could have solved the inflation problem at 2%. Very easy to solve it. You just don't print any money. You know, inflation is a monetary event, but they've been printing. They don't care. The reason why is because they realize that what's more important is the stability, right? Literally the stability of the economy. So it's not full employment. That's an assuming assumption that you have stability. So now right now, when Warsh has his meeting, they're not, what I'm about to say, they're going to ignore in the room. They're going to ignore the elephant. The elephant's over there, but they're not going to talk about it. If Warsh was honest with him, but he can't be honest, because if he's honest, then it'll leak, and if it leaks, he'll sound like a complete idiot. So he can't tell the truth. We're in an era where you can't be transparent, because if you're honest and transparent, you get attacked, because people attack what they don't understand. So if Warsh was honest, if he sat down in the room and he go, okay, people, we have a big problem here. We have to ensure that the stock market doesn't crash, and we have to ensure that the bond market remains stable. And that's his job, literally. That's the elephant, those two issues. We got to ensure that the stock market doesn't crash and the bond market doesn't become fragile. But he can't say it out loud. And so that elephant is just going to keep getting, every meeting that they have is just going to keep getting bigger and bigger and bigger. And at a certain point, somebody in the room is going to go, okay, the stock market's down 5%. What are we going to do here? So it's about clown world, because we can't tell the truth. We can't be honest. Somebody yesterday on Twitter, they posted a list of 20 items where nobody's went to jail. There's 20 things, and nobody went to jail on all 20 items. And we know that all 20 of them, people are breaking the law. We live in clown world now. And so the Fed has become clown world as well. And again, the only thing that really matters right now is stability in the stock market, stability in the bond market. Everything else is noise. And gold is going to be the eventual winner. We can see where this is going. The Humpty Dumpty crash is coming.
Central banks traditionally focus on controlling inflation and supporting employment. However, today's policymakers face an additional challenge: maintaining confidence in increasingly fragile financial systems. High debt burdens, elevated asset valuations, and interconnected global markets leave little room for policy mistakes. Every interest rate decision now carries significant consequences for stocks, bonds, currencies, and economic growth. Critics argue that maintaining stability has become the dominant objective, even if other policy goals take a back seat. As financial risks accumulate beneath the surface, investors closely watch every signal from policymakers, knowing that confidence itself has become a critical economic resource.
So for me, it's a lot like Michael Burry in 2005. He basically saw that the housing market was going to burn to the ground, and he basically said, okay, what strategy am I going to use to maximize my profit?
Mm-hmm.
And he basically went after the worst of the worst. And then if you watch The Big Short, he basically went after the best risk reward, and he called it a certainty. And it turned out he was right. And for me, kind of that real high risk reward, that kind of the meat that he went after, is what I call a sweet spot. And so you want to ignore kind of the low alpha, which is the top 20 majors, your ETFs, and your royalty plays. Now you're going to get three baggers from those. I use them for diversification. Those are kind of like the base of my pyramid. But that's not where I'm going to make my money. The only reason why I own those is because I don't know when the reset occurs. Mm-hmm. I don't know if it's going to be in 6 months or everything in 5 years. So I got to have a foundation. So I use those stocks as my foundation, my base, which those have less volatility, but they still have three bagger upside. At least three bagger upside, in my opinion. And then the meat right in the middle, if you will, is undervalued producers and high quality developers. And that's kind of where you want to be. That's where you want to be 60, 70, 80% of your portfolio, for me, is those really high risk reward stocks. And then the very top is your exploration or options. And I think you can just ignore those. You don't need them. In a bull market, I believe they just go after the real juicy high risk reward, your undervalued producers and your high quality developers. And my portfolio right now is pointing to a seven bagger. When I started doing this, I said my goal is a five bagger. And I'm always conservative, and I'm like Burry. So Burry, I'm sure when he looked at his numbers and he looked at it, he basically, and it turned out, you can project out kind of what you're going to get. One of the question was, when do you leave? Well, for me, I'm not going to climb to the top of the mountain. There's no reason to. So right around a seven bagger, I'll be out. But
periods of market transformation often create opportunities alongside risks. Some investors believe the greatest potential lies not in broad market indexes, but in carefully selected sectors that remain undervalued. Precious metal producers, developers, and resource companies attract attention because they may benefit from rising commodity prices while still trading below historical valuation levels. The key challenge is identifying quality assets before widespread investor enthusiasm arrives. Experienced investors frequently emphasize patience, focusing on strong fundamentals rather than chasing short-term trends. In major bull markets, the largest gains often occur when skepticism remains high and valuations remain relatively attractive.
If it's really juicy, if it's still really frothy, but you have a lot of momentum, maybe I'll stick around for 8, 9, maybe. But I probably won't. I'll probably exit early. But now, Burry, as soon as he basically, once his plane landed, he got out. He didn't wait. And so some people, and I've thought about this, about leaving early, because he left early. As soon as he started making money, he was out. Whereas Mark Baum, he waited another year before he got out. And so some people are going to wait longer than others. I'll be in the middle of those two guys. Mm-hmm. I won't get out early. I won't get out late. But you don't want to. You do want to be careful. You want to wait. I've told people, when do you begin to exit? This is a key question you didn't ask. When do you begin? You
Hmm.
don't begin to exit until it gets frothy. Now, what is froth? Froth is basically your PE ratio. So if you look at the current stock market, we have froth. We have froth up the yin yang. The
Sure.
price Schiller PE is at 42. The all-time high is 44. And so you have froth there. So that's how you can tell. It is the PE ratios. I don't use PE ratios. I use free cash flow multiples. And the free cash flow multiples right now are in single digits for your producers, for both gold and silver, single digits, which is really cheap. And the reason why they're really cheap is because nobody believes in my thesis. Everybody thinks that everything's fine, gold and silver. No, they already had their run. Silver went to 120. It's done, right? So nobody cares about these. So free cash flow multiple under 10, and they're going to double. And so so one of the things I look at is your highest quality producers. Those highest quality producers should all get into the 20s. And so once a few of them get into the 20s, that'll be early exit. Once they all get into the 20s, then get ready to get out. And then we don't know how long the mania will last, but that's when, I'm not going to be there for the very end of it, how long this thing lasts at the very top. But I could leave. I expect to leave a lot on the table. But like you said, you don't know what the financial system is going to do here when things start to break. So I'll definitely be exiting, once it gets frothy.
No one can predict exactly when major economic transitions will unfold. History suggests, however, that excessive optimism eventually gives way to caution. Successful investors often focus not only on entering opportunities, but also on planning their exit strategy. Valuations, cash flow metrics, and market sentiment can offer clues when enthusiasm reaches unsustainable levels. As technology, debt dynamics, geopolitical tensions, and monetary policy continue to reshape global finance, flexibility becomes essential. Whether the future brings a severe correction or a gradual adjustment, one lesson remains consistent. Preserving capital and adapting to changing conditions may prove more valuable than chasing every last gain.
So when I wrote this book in 2012, at that time, I thought that, it was a complete guide. So I thought, okay, I better include a chapter on options here.
Hmm.
And the main thing that I mentioned, not main, but one thing I mentioned as an opportunity you could use for options is hedging. Because hedging, using options gives you a lot of leverage if things go south on you. So I thought, okay, I'll write a chapter on options. And the last book and I think it's going to be my final book, the 12th edition. It might be the 13th edition. I've done so many of them. I've updated it so many times. I removed that chapter. It's not there anymore. And the reason why is because now we're in the bull market. So in a bull market, I really think the options is not easy. You really need to be a professional to use options. It's difficult. There's so many. One of the things they say about options and trading alone. So here's the thing about options. Just trading, period. Only about 20% of the people make money in trading. If you trade options, it gets worse. It's like 10%. So 9 out of 10 people are going to lose money trading options. So it's like, so I removed it from the book because I just don't really think you need it. Now that we're in a bull market, there are 5, 10, 20 baggers still all over the place. So when you have that much leverage in the system, you really don't need to gamble with options. Now, a lot of people are going to do extremely well. It almost seems like a slam dunk for some of these options, but I just told you 9 out of 10 people lose money. But I mean, if you look at like SILJ, for instance, it's an silver miner ETF. So you're
Junior
kind
miners, yep.
Yeah, so you're kind of reducing your risk of basically a problem for one mine, right? Now, there are people that have options on SILJ that they bought like a year ago, all the way to January of 28. They got in like It's like 25 right now, 27, 28. They got in like when it was under 10 before this market really took off, and they're going to make a fortune. And so if you get into these options, the key is now it's getting a little more difficult. Bull markets aren't as easy, but timing is huge in options, right? So people that got in to like SILJ when it was under $10 and they're riding it all the way until January 28. I mean, those guys they're going to print money. It's going to be I don't see SILJ going back to 10. It's currently about 28, 29. So sometimes, options are a thing of beauty, but in a bull market, the thing that bites you in options, again, is the emotional part of it. And the time, it's all about timing, but it's not only about timing, it's all about how you manage your money. It's very difficult. And so I'm not really a fan of it. I have bought options on hedging. I don't do it anymore. I basically broke even, but I learned. The one thing I don't like about options is they have a limited time frame. And so I don't know, when I might want to exit. So right now, a lot of people they'll have an option, let's say January of 27, right? It's going to expire right before I think that 27 is probably going to be the best year ever for miners is my expectation.